Hi, I'm Linda Eedes, and with me today I have Portfolio Manager Nick Balkin, and we're going to be talking broadly about Foord's multi-asset class views. So Nick, let's chat a bit about the market backdrop. 2022 has brought with it a very different environment than what we saw last year, and we've gone through a few inflection points as well. How do we actually position and manage the funds through those inflection points? Do we manage for them, or do we kind of look through those inflection points?
Yeah, I think Foord have always done very well to manage the inflection points. I think if we take a step back, in order to prepare for the inflection points, you have to actually be prepared and managing the portfolio before the inflection point comes. It doesn't help to actually try and manage an inflection point, meaning a big drawdown in markets as it's happening. The portfolio has to be prepared. And being long-term investors at Foord, we're looking 3 to 5 years out. And we're thinking about where the fundamentals are. If we take a step back, what we're trying to do is actually understand the value of a cash flow. We try and discount those cash flows and understand how to achieve an inflation-beating return with the lowest possible risk. In doing that, we try and kind of avoid looking at where markets are going and where the peers are going, because you can get caught up in that, and that kind of deflects how you think about the fundamentals of markets. So in order to manage inflection points, you need to be prepared, you need to stick to the fundamentals, and you need to look 3 to 5 years out and be prepared to be different.
And so talking to that, I mean, we have been speaking about these rising inflation risks for quite some time, a lot longer than the market has been talking about them. That seems to be the preoccupant risk that everyone is concerned about at the moment. And, last year was a difficult year for our funds as a result, but this year that cautious approach seems to have stood our multi-asset class funds in good stead. Are we still cautious about where we are in the cycle and how we positioned with regards to how we see that playing out from this point?
It is a vitally important point. I think we were blowing the trumpet, on high inflation for longer, and I think the key cause was kind of known by everyone, which is low interest rates. Low interest rates mean that things are operating above where they should. And when that happens, the unemployment rate in the US gets to below 4%, and there's huge pressure points in the inflationary world. So I think we've been looking at that and being very cautious about that inflation. And the reason we're kind of cautious about that is because the world's run ahead of where it should be. Effectively, interest rates have stayed low for long. We knew that interest rates would have to normalize in that world. The problem is market rating, or the S&P where it was operating in a world where it thought interest rates would stay low for a very long time. So the biggest issue for us was always that the market valuation implied a low interest rate forever. We knew that inflation was going to come through, and therefore interest rates would normalize. The maths of how markets work is rising interest rates therefore bring down the market valuation. It wasn't as a result of some decrease in consumer spending. We haven't even seen that yet. What we've seen is just the outcome of rising interest rates, which has lowered the market. So a lot of people have felt that a minus 20% drawdown in global markets is a huge panic, and it's like a global financial crisis. We're not even nearly there because the market rate is only at the normalized range. We are still not at a point where the market is very cheap, that we can just fill our boots. It's important what we select and how we protect still. I don't think we're kind of off to the races and think that this is a free-for-all to kind of just make money. We have just normalized from an abnormal world right now, and there's still a lot of variables that we need to deal with before we're comfortable that we're off to the races.
Okay, so we are still quite cautious, but of course we know that managing particularly the inflation-beating funds, we do need to take exposure to those assets which are going to give us real returns over time. So how are we doing that within the multi-asset class funds, particularly speaking to equities? And then are we starting to increase our exposure, having seen yields go up a little bit, to other asset classes such as bonds, for instance?
It's not an easy question to answer because one of the most important things is there's an interplay between the different asset classes. And to answer it simply is not that easy because there are some bonds that are offering good opportunity, but then there's some equities that are offering good opportunity. One of the most important things you need to understand is although there is the S&P and the JSE All Share, we don't buy the index. We are buying individual stocks. within the index, there are very interesting opportunities in the equity side of things, and there are also very interesting opportunities in the bond side of things. So it's quite specific. As a whole, as I communicated, the S&P and the JSE have normalized to a certain extent from a valuation, but not that cheap. Within there, I think there's a lot of opportunity. And importantly, what I haven't said is, in order to achieve the inflation-beating return, a lot of people will say, just buy the bonds and accept an acceptable return. The problem is they are a fixed coupon. And in order to generate inflation-beating returns, you need a mix of equities and bonds. So in our multi-asset funds, we actually have quite a high weighting to equities because they're the best way to pass through the inflation onto other people and therefore earn an inflation-beating return. So I think it is the same as we've communicated before. We have a high allocation to equities, but it's which equities we chose. So we didn't go and get the go-go big US stocks that were overpriced. It's about going back to that income stream that we're buying. We're buying a solid income stream in an equity that we think might not go up the fastest, but will have more certainty. Then we have some bonds that probably aren't the highest duration, but we have a higher certainty, meaning in 4 to 5 years, we'll get our money back and an acceptable inflation-beating return. So I don't think there's any change versus the last time we've communicated. I think it's about being, as I said, prepared and therefore we don't change that often. Our average holding period is 5 years. And at these inflection points, there's no sudden knee-jerk reaction to do something because we've already done something before. So I think importantly, it's to own both. It's not to go 0-1, no equities and no bonds. We have a high weighting in equities, but they're high quality, and a healthy weighting in mid-duration bonds.
So speaking to the balance between sort of local equities and offshore equities, local and offshore as a whole, within obviously the local funds where we are able to take offshore exposure. Let's look, for instance, at the Regulation 28 fund, the Foord Balance Fund. Now we know that offshore limits have been increased this year. Have we made full use of that? And if not, what would be the trigger to actually increase our allocation to offshore equities in particular?
I think every time they've raised the Reg 28 allowance, we've kind of been at the maximum from 20 to 25, 30. As they've gone higher now, we've said that importantly, we have RAND benchmark funds. And understanding that is you don't want to have too much exposure on the RAND benchmark funds to offshore, and then you have this big dislocation that the RAND goes to 13 and suddenly you have this big underperformance for a long period of time as a result of that. So I think we think the happy medium is between 30 and 35% in offshore, and we'll tactically take it up and we'll tactically take it down. But therefore, the new allowances have allowed us to be more tactical because we don't need to be at the maximum. So I'd use a rough 30 to 35% as a kind of through the cycle offshore number for the new changes.
And then finally, Nick, the question that's obviously on all investors' minds, are our inflation-beating return objectives for our various funds, and obviously that depends on the risk of each fund, do we think they're achievable? I mean, in an environment that inflation is far higher, do we still think that we can actually achieve inflation-beating returns per each of the funds for our investors over the next 3 to 5 years?
Yeah, no, it's an important question. I always laugh at that question because what do you want me to answer? I mean, it's the honest truth. But no, the truth is we actually believe it. We know it all comes back to fundamentals. The important thing of how Foord invests is we're not relying on the sentiment of what the market will do because other people are doing it. You know, the buyers and sellers, more buyers driving up a share price is not generally kind of how we manage money. So why I can answer it with conviction is on a 3 to 5 year basis, the companies that we're owning, like a SPAR, like a bank, you know, they're generating a good dividend yield, and I know what earnings growth I can get out of them in good and bad times. If I combine the earnings growth and the dividend, I know that I have an inflation-beating return out of a lot of those stocks with a high certainty. When I own a 10-year bond in South Africa yielding more than 10%, I know I've got an inflation-beating return locked in. That doesn't mean that I can give it to you every year because market sentiment, as you've seen more recently, can mean that there are periods where it doesn't happen. The important thing at Foord is to make sure we go down less than people when the market comes down, and we have that protection to fight another day. And therefore, we start at a much higher base once the market recompounds and confidence comes back into the market. So I think that's the important thing. We can't guarantee it every year, and we shouldn't guarantee it every year. But we have a high conviction that on a 3 to 5 year basis, we will do it because it's driven by fundamentals.
And I think, certainly this year where we've seen a lot of asset classes in negative territory from both the local side as well as the global side, I mean, the funds are holding their ground. So that speaks to what one needs to do during this part of the market cycle. And then obviously over time, all of these things that you're talking about actually come through to generate that absolute return profile over time for our investors. Thanks, Nick. And we will continue this conversation next quarter. Thanks, everyone, for joining us.